Welcome to Fear and Greed, the week ahead. This is where we take a look at the big events, reports and releases coming up this week that give insight into the economy. And of course, a look back at what happened last week too. I'm Sean Aylmer, and every Monday I'm joined for the week ahead by economist Stephen Koukoulas. Not surprisingly, you'll find him at thekouk.com, thekouk.com, and on Twitter using the handle thekouk. Stephen, good morning.
Good morning, Sean.
So last week, a kind of a mixed bag in many ways. Let's start with retail sales.
Yeah, we had the retail sales for the month of May. They only rose 0.1, which was a fair way below market expectations. But when you drilled into the numbers, there was a 1.5% fall in Victoria. And of course, it had those couple of weeks of lockdown impacting those numbers. So look, the lockdown numbers are real. Of course, they do impact consumer spending, but they were just a touch weaker than the market was looking for. And just not putting a question mark over the recovery, but just it's 1 month's retail sales numbers, but we'd prefer them to be a bit stronger.
Okay, and then you'll probably get a bit of an effect this month as well in New South Wales and particularly Sydney.
Oh, no doubt about that. Look, we'll probably see another softer number in June. But again, I don't think that's going to derail necessarily the recovery that we've been talking about for the last few weeks.
Okay, so that's retail sales. Take the other end of the spectrum, and that's trade. Wow.
Oh, yes, three good words. Wow. A $13.3 billion monthly trade surplus and a record high.
Paul Keating must love it.
He must be dancing around his little office there in the middle of Sydney. But like $13.3 billion for a month. So it looks like the quarterly number, month to month there's a bit of choppiness. So the quarterly surplus will be around about $30 billion. And no surprises really with the iron ore price still well above US $200 a tonne. The volumes are booming. The demand for iron ore is unrelenting. And even the coal price, the dreaded coal industry is doing pretty well because a lot of the coking coal and other coal prices have been also very strong. So we're running a massive surplus. And of course, our import levels, the other side of the ledger in terms of the trade balance, are not super strong. We're just not having that rampant increase in domestic demand that normally feeds into an increase in import volumes.
Okay. Now, the other numbers I thought out last week, which are pretty interesting, I suppose not too surprising, we're all richer.
We are richer. Indeed, we had the wealth effect. And of course, wealth hit a record high, and even on a per capita basis, which of course is the best way to look at it, we're just under $500,000 per person in wealth. And that, of course, includes the value of housing, the value of superannuation assets, which we know are above $3 trillion now in total. But the per capita wealth numbers are really reflecting this boom in house prices that's been evident for, 9 months now, and that, frankly, quite stunning recovery in the ASX from the low point around about this time last year. So we're feeling wealthier. We are wealthier. Of course, it requires house prices to continue to grow and the ASX to continue to consolidate and rise as well for that to be built upon. The interesting thing about the wealth effect, the wealthier we are, the more inclined we are to spend. And so this is actually one of the indicators that the Reserve Bank look at when they're trying to forecast household consumption spending.
Thanks, Stephen. That was last week. In a moment, I'll be back with Stephen Koukoulas to talk about what's coming up this week. I'm with economist Stephen Koukoulas, a.k.a. The Kouk. So this week, Stephen, a few numbers. Let's start with house prices because we love house prices on Fear and Greed. In fact, everyone loves house prices. What do you expect from the core logic data?
We've got a fair bit of the numbers already for the month of June, it will be. We know that Sydney will have a monthly increase around about 2%, 2.1%, something like that. So continuing this incredible run, I think we're up to 5 months now where the month-on-month increases have been between 2 and 3%. So annualise those sorts of numbers and not surprisingly, you're getting about a 20% annualised increase in Sydney. But the curious thing is that it's happening in all the other state and territory capital cities. We're seeing double-digit annual growth in prices across the board and, of course, in regional Australia too. CoreLogic do break their numbers down into regional Australia and, of course, they're increasing at double-digit annualised growth rates as well as people are moving from the big smoke into the rural areas for just lifestyle changes. So The housing market's still booming, interest rates are low, the banks are still providing relatively easy credit and the market's still strong.
So do you think that'll continue after this week when the Reserve Bank Governor Philip Lowe speaks? Because he must be thinking a little more about tightening monetary policy. I mean, Commonwealth Bank and Westpac both came out last week saying that in the next couple of years rates would rise well ahead of the Reserve Bank timetable.
Yes, indeed. In fact, a number of banks sort of starting to flag the possibility of a rate hike. Not anytime soon, but as you said, in the latter part of 22, maybe early 23, that the RBA will not be requiring a 0.1% cash rate like we've got now. So Phil Lowe will it'll probably focus more on the other elements of monetary policy. The ending of the bond buying, or the curtailing, I should say, of the bond buying, and perhaps not extending their yield curve control out beyond the April 2024 bond, without getting too technical. But they're really probably just going to say, look, some of the quantitative easing, broadly defined, will be starting to be scaled back because the economy is just so strong. Demand for labour is strong. And we've got to think back to those labour force numbers that we saw a week or two ago. They were fabulous. And I think the RBA was surprised, but pleasantly surprised.
So in effect, Stephen, does this mean that fixed term rates on home loans will start rising?
Look, the short answer is yes, because what we see, the way that the banks price their 3, 4, 5 year fixed rate mortgages is from the swaps market, which is linked to the yield on government bonds. And already, just in this last few months, as the better economic news has come through, we've seen the 3-year government bond, just to use that one as the benchmark, has risen from about 0.1% to about 0.4, 0.5%. And so the banks have already started announcing increases of 10, 20 basis points on their 3 and 4 year fixed rate products. So look, in itself, that's not a huge amount. And of course, it doesn't impact anybody who's currently got a mortgage. But for those new mortgage holders, it looks as though we're in the early stages of what's being called the reflation trade. And the discussion about whether and when interest rates will be going up is starting to intensify, with some of the really good bank forecasters out there thinking that the RBA will have to rethink its timetable. And not that it's going to happen soon, but certainly in the middle of next year, the latter part of 2022, we could be seeing the RBA starting to get a bit hawkish. And of course, financial markets anticipate those moves. So, the money market bond yields, if you like, are likely to keep creeping higher over the next little while.
Another couple of things I just wanted to mention. The superannuation guarantee increases this week from 9.5% to 10%. So for the majority of workers, their take-home pay for July will actually be slightly less than June. There was a huge debate about this a few months ago when they were talking about not lifting the superannuation guarantee, but it will have some sort of economic impact.
Oh, and there's no doubt, of course, because a lot of people's salaries are packaged up to a particular amount. And if the 9.5% SGC superannuation guarantee charge goes to 10, well, then the other component drops by that 0.5%. That's sort of the mechanical element of it. But that said, we've seen the increase in the minimum wage from the Fair Work Commission just recently, the 2.5% increase that's going to be paid from the 1st of July. And the other issue, Sean, and this is the biggest one, look, acknowledging fully that the superannuation increase has occurred, the labour market is tightening. We're hearing surveys almost weekly that firms are finding it very, very difficult to find the workers they need, skilled workers, semi-skilled, unskilled workers even. And that's putting some upward pressure on wages. Now, we haven't had wages data for a little while. And in fact, even when we get the June quarter and September quarter data, it's probably a bit early. But I'm wondering whether the economy will be strong enough, the labour market tight enough to overcome that 0.5% reallocation of some people's pay from take home into their super accounts.
I suppose job vacancy numbers this week might give us an indication of that.
Oh, indeed. And these are the official ones from the Bureau of Statistics, because we do have ANZ indicators and Seek producer job vacancies indicator, and they have been really buoyant. The demand for labour, as we were just saying, is very strong. We're not getting these sorts of GDP results that we've seen recently without, a requirement for more people to work. And with the borders shut as well, that use of the visa door, if you like, to get skilled workers into the economy is no longer there. So we've really got this demand for workers. The job vacancy rate's probably going to be another strong number.
Yeah. Stephen, have a great week. Thanks for talking to us.
Thank you, Sean.
That was economist Stephen Koukoulas, better known as The Kook. You can find him at thekook.com and follow him on Twitter using the handle The Kook. I'm Sean Aylmer, and this is Fear and Greed, the week ahead.